Hello everyone. The topic for this week is financial statement analysis and introduction. This is the first topic of our module and we will cover it in three small tutorials that will cover the different elements of this topic. The learning objectives for this week's topic include an understanding of the role of the financial reporting and financial statement analysis, analyzing the usefulness and importance of financial statements and their analysis, and identifying and explaining the different sources of information that analysts use in financial statement analysis, and finally, developing an understanding of steps in financial statement analysis. Financial analysis is the process of examining a company's performance, and this performance may be past, present, and future in the context of its industry and the economic environment in which it is operating. And the objective or the purpose of this examination or evaluation of performance is to arrive at a decision or a recommendation. This may, for example, include that whether one should invest in the debt or equity securities, that is bonds or shares of the company, and if the answer to this question is a yes, then at what price should one buy the bond or the share of the company. There are many other uses or decisions that are based on financial statements analysis, and we will be exploring them further. Financial analysis focuses on evaluating the company's ability to earn a rate of return at least equal to the cost of capital of the company, that is the WACC, its ability to profitably grow its operations, and its ability to generate enough cash so that it can meet its maturing obligations and operating expenses, as well as allow itself to pursue any opportunities for growth. This growth may be organic or through mergers and acquisitions. Basic financial statement analysis always starts with the company's annual report. The company's annual report contains the audited financial statements of the company. These include the balance sheet, income statement, statement of changes in owner equity, cash flow statement, and notes to the financial statements. There are additional disclosures that are required by regulatory authorities. These include the statement of corporate governance and the auditor's report. In addition, the unaudited commentary by management is also part of the annual report. In some jurisdictions, such as Germany, it is required that the management commentary is audited. Financial reporting and financial statement analysis are highly related. However, they are different. Financial reporting is responsible for providing financial information in the form of financial statements to the users for making decisions. Financial statement analysis is concerned with using financial information from financial reporting to assess the prior performance as well as the expected future performance to make decisions. These decisions may include capital allocation decisions, mergers and acquisition, borrowing, lending, etc. One point to note here is that financial reporting is not limited to financial statements that we know, for example, balance sheet, income statement, cash flow statements, etc. However, there are other financial reports that financial reporting provides. These include reports filed with government agencies, president letter and supplementary schedules in the annual report, news releases and management forecasts, social or environmental impact statements, etc. Here we have an earning announcement from Apple for the second quarter in 2012. It states that Apple reported $39.2 billion in quarterly revenue and the quarterly net profit was $11.6 billion or 12.30 per diluted share. Compared to last year's second quarter, when the sales were $24.7 billion and the net profit was $6 billion or $6.4 per diluted share, the net profit has shown an increase of 94% year over year. The gross margins have been 47.4% compared to 41.4% for the same quarter last year. And the main attribute is that international sales accounted for 64% of this quarter's revenue. Earning announcements are an example of a financial report other than the financial statements, and they are typically accompanied by the financial statements also, particularly the balance sheet, the income statement, and the cash flow statement, which may be audited or unaudited. Typically, regulations do not require quarterly financial statements to be audited, but annual. The first paragraph here is outlining information that is important for investor. This includes growth in revenue, growth in profit, the overall profitability in terms of gross profit margin, and the growth in dividends over time. The information about international sales is speaking about the diversification that Apple as a company has, and it is also a reflection that its business risk is not concentrated geographically. Now, here we have a paragraph from an article written by a research company that has analyzed the Apple's quarterly announcement of its financial results. Analysts compare results to expectations, that is, consensus estimate from the analyst community versus the actual results, and they focus on growth in both revenues and earning per share. Earning per share in particular is very important as it is one of the input used to calculate the price earning ratio, which is the most common valuation multiple used across financial markets in valuing equity. Analysts also focus on profitability. It is important to note that the role of financial analysis is not only to describe the financial performance of a company, but also to identify and explain the underlying drivers of the financial performance of the company, evaluate the performance relative to expectations, competitors, and the historical trends in performance. And on the basis of all this, form expectation about the company's future performance. From this, we can understand that financial analysis is concerned with evaluating the financial performance of the company over past, present, and future. In the case of Apple, we see that Apple has performed better than expectations in terms of revenue, profits, and dividends. Higher profits were made possible by growth in sales and higher gross profit margin. The higher gross profit margin was the result of lower input prices for Apple's products. We see here that financial analysis are not only describing the financial performance of the company, but also explaining and evaluating it and allowing to form expectations about company's future's performance. Financial statement analysis has different uses. It can be used by an equity investor to analyze a company to identify attributes of the stock of that company that can help him decide whether to include or not the stock into his or her portfolio. The investor can use the financial statement analysis tools and techniques to value the stock to identify whether it is overvalued or undervalued. A firm may use financial statement analysis to identify suitable merger or acquisition targets or opportunities. A parent company may use financial statement analysis to evaluate the performance of a subsidiary or an operating division. Similarly, a venture capital fund or a private equity fund can use it for making investment decisions related to funding venture capital or private equity opportunities. Financial statement analysis are most commonly used for analyzing the creditworthiness of a borrower by lender. Particularly banks and other lenders use financial statement analysis to analyze companies when they are deciding on loans. Financial statement analysis are quite useful in making trade credit decisions by companies. When a company is considering whether it should sell on credit to another company, it can use financial statement analysis of the client company to inform itself about the creditworthiness of the client company and then make the decision on whether to sell on credit or not. Financial statement analysis are also very important in examining the compliance with debt covenants and other contractual arrangements in lending agreements. For example, in a lending agreement, a borrower may be required to maintain a debt to equity ratio of not more than 40% at any time over the term of the loan. Similarly, the borrower may be required to not pay more than 40% of its earning as dividend. Financial statement analysis will be quite useful in such a case in determining whether the borrower is meeting these two covenants or not. Financial statement analysis are also used in assigning debt rating to a company or its bonds. Financial statement analysis are used to calculate different relevant and important ratios that are used to assign a credit rating to a company or the bonds it has issued. Financial statement analysis are also used for valuation of securities, both debt and equity, and make investment recommendations of whether to buy, sell, or hold each. Financial statement analysis are quite useful for forecasting the financial statements, which are used to forecast future net income, cash flows, dividends, capital structure. All these are important for investment analysis, financial analysis, credit analysis, and valuation of financial securities.